So let me ask you a question. If the smart money is so smart, why do they all own the exact same large caps tech stocks as each other, as well as everybody else out there in the world? Seriously, I want you to think about that for just a second, because everybody talks about the smart money out there on Wall Street, all these brilliant guys, and they literally have the same portfolios as everyone else out there. So if I walked into a room during an IQ exam and every single person had the exact same answer on the test, no one deviating from the norm, I would just assume they all copied off each other and there wasn't any individual thinking going on. The good news for the people who are taking the test is, if it's graded on a curve, none of them will really suffer for not knowing the right answer. And that's exactly what's happening in the stock market as we speak. Hedge funds, institution, the smartest investors in the room, as they're so called, they're pretty much all piled into the same 10 names, same stocks, same stories, just slightly different marketing decks for potential investors. And today, we are going to break down the 10 stocks that the smart money has the most invested in, the 10 stocks that have captured the attention of retail investors, and what happened the last time everyone heavily bought into the same dominant tech names, regardless of valuation. And then finally, why blindly following smart money might be one of the most dangerous things you can do as an investor. Because here's the uncomfortable truth that you have to know and understand. Smart money isn't always smart. Sometimes smart money is just doing everything they can do to avoid looking dumb, making the easy choices and simply following the crowd, because who could possibly imagine getting fired for owning NVIDIA in 2026, even if it fell 50% from here? Everybody else owns it. This was the name. It just fell. Not my fault. Now, before everyone loses their mind in the comments, let me be very clear about something. This video is not about saying hedge fund managers are stupid. They're not. They are smart people. They're highly educated. They go to the best schools out there, and they have access to loads of analysts and at-the-minute information most investors may never even see. But intelligence and incentives are two very different things. Hedge funds don't invest the way you invest. They can't possibly do that. They're managing other people's money. They have clients who can pull capital from them if performance isn't good. They have quarterly performance reviews. They certainly have egos. And most importantly, they have something that's not discussed a lot. They have career risk. You and I, if we invest our own money and we're building our own portfolio, we don't have those restrictions. We can sit there and be as patient and long-term thinking as we want to be. And time again, this is proven that the best investors do this by holding good assets for long periods of time. But a hedge fund manager, they're not going to get fired for being pretty close to the market. If the S&P is down 10% and they're down 11%, no one cares. They can simply blame the unpredictable macro reasons for the losses and point out that all their peers lost money as well. And if the market is up 15% though, and they're down 20%, they're done. Investors will be calling to pull that money. Their high-paying job will be gone, and their once massive ego will be destroyed. So what does that create? It creates an environment where following the index feels safe, owning popular stocks feels responsible, and being different from the crowd feels extremely dangerous. That's why the smart money tends to cluster. That's why they all own the same names. And that's why, historically, the biggest mistakes in investing happen when everyone magically seems to agree. Now let's stop talking theory and let's look at the actual data, because we've done the research for you. These are the 10 stocks hedge funds own the most, ranked by total dollars invested. As you go through this list, I want you to ask yourself one simple question. Does this look like bold contrarian thinking? Does it look like the type of moves that spark outperformance? Or does this look like the safest way to explain yourself if things go wrong? So here we go. First stock, Amazon. Shocker, right, guys? Roughly $150 billion owned across 332 hedge funds. Global dominance. Amazon Web Services. Massive scale. If you say you own Amazon, nobody asks follow-up questions. They just nod their head in agreement. This is where everyone goes to shop. This is the everything store. You're crazy to think that Amazon can be overpriced. Why? It's such a great story. Number two, and this one's funny for me, Microsoft. Because 13, 14 years ago, the story I always tell is a tech CEO told me I was dumb for buying Microsoft at between $17 and $22 a share at 9 times earnings since Microsoft was dead. But $100 billion is owned across 312 hedge funds. This has basically become the definition of institutionally acceptable. Number 3, one that I didn't see many hedge funds buying at $88 a share, but Meta. $90 billion with 273 hedge funds involved. What's interesting is that 2022, Meta was not a hot stock. Why? Because everybody hated Mark Zuckerberg. Why? Because the stock was down. And guys, everybody said there was no user growth. There was user growth. People said they were losing money like crazy. They were not. They were losing money on the metaverse, but they were making $30 billion extra on everything else. And they said this was a dying company. That dying company was not growing very fast, but guess what? That's where value investors become most interested because reality and the truth were disconnected. Since then, the shares are up over 8x. Buying Meta as it fell was contrarian, and that is exactly how outperformance becomes possible. Guys, before I get into the next 6 stocks, this is precisely why I teach on YouTube, because I saw the world of investing and I saw people just saying generic storyline things, saying, oh, this is amazing. And I realized that people don't really care about the data. They care about the story. The story makes us feel warm and fuzzy inside. If you're a salesperson, what are you taught? You sell in a story. You tell a story and that sells everything. That's what happens in the world of investing. Amazon, great company. Look at this thing. Everybody goes there. Guarantee you something. If Amazon stock were to fall 60% for a long period of time, people would declare it dead. That is a reality. I want to change that narrative for you. I want you to be the contrarian thinker in your group. Now, number 4, the good old googly moogly, Alphabet. Another $90 billion held by 243 hedge funds. Guys, they have search, they have YouTube, they have advertising. It's a simple narrative, consistent cash flows, not the slightest bit of surprise to see this one make the list. Number 5, NVIDIA. Okay, $90 billion across another 234 hedge funds. I'm actually surprised it's not more hedge funds, to be honest with you. The AI story has made this company almost untouchable. Nobody for the past 5 years wanted to be underweight NVIDIA. I'm actually surprised this one isn't higher, like I said before. Now, stock number 6, Apple. $80 billion across 166 hedge funds. So a lot less hedge funds. But I would argue this one is actually the most widely loved stock in modern history. And you might be thinking to yourself, Paul, isn't Apple Warren Buffett's largest position? The answer is yes. Back in 2016, when Warren Buffett was loading up on Apple, the PE was between 10 and 15. And now Buffett has been selling significant amounts of Apple shares while it trades at a PE of over 35. So not only has the company become a lot more profitable, the PE has over tripled since then. Number 7, Taiwan Semiconductor. Okay, $70 billion owned by about 194 hedge funds. Now this one's interesting because Taiwan is situated in the middle of political tensions between the US and China. Number 8, Broadcom, AVGO, $65 billion held by 183 hedge funds. This is a dominant large cap chip company forecasting massive future growth, especially in an industry that has a lot of growth attached to it. NVIDIA with the chip, anything related to chips has a lot of growth potential. Number 9, Visa. Our first non-tech one, basically. $50 billion owned by 179 hedge funds. Simple, stable, and boring in a good way. This is the definition of that old adage. No one ever gets fired for owning a certain type of stock. Visa is one of those stocks. If Visa doesn't perform well, they'll have an excuse because who could have seen that coming? This company makes money as people spend, and around the world, people are spending more and more. And what is the number 1 credit card brand in the world? Visa. This one will do well over long periods of time. The fundamentals will. The question is, can you pay a reasonable price? And finally, number 10, Netflix. About $40 billion held by 154 hedge funds. Even after recent volatility, institutions stayed. They've been the clear winner in streaming, capturing massive market share. Okay, now I want you to take a step back and really look at this list. These are phenomenal businesses. No argument whatsoever from me or anyone else probably. But they're also the most obvious businesses on earth to own. This isn't smart money discovering underlying value that you aren't seeing. This is smart money making sure that they're going to avoid embarrassment at all costs. And that distinction matters significantly. Now, let's flip the lens and look at the other side of the market. These are the 10 stocks that retail investors own the most. And this is where things start to get very interesting. Stock number 1, Apple. Guys, a jaw-dropping $1.5 trillion, the single most owned stock by retail investors, and it isn't even close. What did I tell you in the last section? Apple is the most widely loved stock in modern history. A good friend of mine, who I think is great at looking at personalities and people's behavior, says, I will believe we're close to the end of the next bear market when people have given up on Apple. That's where I'm going to go, okay. Apple will be the go-to of like, this is the safe one. When people are giving up on Apple, that's when we're close to an end. Number 2, NVIDIA. Makes sense. $1.4 trillion. This AI narrative pulled retail investors in really hard, actually even harder than smart investors. When a story works, money will flow there. I always wonder on big winners like this, how many people have actually held since the beginning? How many have actually captured that massive return? If you recall, Cathie Wood has been the biggest destroyer of wealth in terms of the ETF world. Why? Because her fund went up so much that people invested at the tail end when all the returns were already in. Number 3, back to the googly moogly, Alphabet. $1.2 trillion. And again, between YouTube and search, most people use this company more than anything. Number 4, Amazon. $500 billion is invested there. But in years past, this was the darling. Anyone starting to catch into a trend yet here on these names? Have we seen anything different than the smart money? Number 5, Microsoft. Our streak continues. I'm sure retail loves the stability of this business. Monish Pabrai, a friend of the channel, always says the market will pay up for consistency and heavily punish uncertainty. Even though uncertainty is where the money is made. When there's uncertainty, people leave. When people leave the investment, the price falls. Number 6, Tesla. $380 billion. Okay, our first outlier. About time. Retail certainly embraced Tesla long before institutions did, and it appears they may not have given up on Elon Musk despite the headlines. Number 7, Meta. $750 billion invested there. Another name in common with smart money. Here's it. Number 8 is a deviation. AMD. Okay, $50 billion of retail investors' money sits in this one. Although this is different than the smart money, I would say this one rhymes with Broadcom quite a bit. Number 9, Netflix, around $40 billion worth. And finally, number 10, the good old Palantir, about $30 billion invested. Highly polarizing, heavily debated, and overwhelmingly owned by retail investors. Alex Karp literally went on live TV and threw a temper tantrum over Michael Burry calling out their accounting practices. Guys, this is not what CEOs should be doing. Reacting at all, especially in that way, just makes people ask more questions when the stock finally decides to fall. As the stock is going up, people are going to be like, it's okay. Remember, when Tesla is going like crazy, everything's fine with Elon. Then all of a sudden, Tesla starts to not do very well. All of a sudden, the questions are, is Elon crazy? Is he a psychopath? All these things. But back to the story. I think we can all see there's massive overlap here. For the most part, retail and hedge funds own the same stocks, and that should immediately raise a red flag because history has shown when this happens and everyone agrees, it drives valuations to historic levels. You have hedge funds buying the same stocks. You have individuals buying the same stocks. Now, to really understand why crowded trades are dangerous, we have to go back to the last time investors were this confident on such a few names. Let's rewind to the year 1999. Now, a lot of people here who were even alive back then probably weren't even invested in the market. They were probably in high school or college or early career. Technology was changing the world. The internet was going to rewrite the rules of business forever. And every headline reinforced the same message. In some way, shape, or form, this time is different. Does that sound familiar? It certainly does to me. And guess what, guys? That story about the internet was probably undertold. The internet did even more than they expected. What was interesting is valuations didn't matter anymore. Cash flow didn't matter anymore. What mattered was owning the companies that would dominate the future. And on December 31st, 1999, what I'm about to show you were the most owned stocks in the market. But first, I want to make sure you understand what happened next. From 2000 to 2002, the NASDAQ collapsed by nearly 80%. Many of these very hot stocks took 10 to 15 years to get back to their previous highs, if they even made it. So let's get into it. The very first stock, and this is the irony of it all, Microsoft. This one's been around, but again, 2000, it was a darling. 2012, I was told by a tech CEO I was stupid for owning it, and now we are, and it's one of the most traded and owned stocks out there. Microsoft shares didn't reach their high from the dot-com bubble again until 2017. That means you would have seen a flat return for almost 2 decades. Number 2, Cisco. And I love this one. This one is even crazier. Just a few weeks ago, it finally reached the levels it traded at in 2000, 25 years later. Number 3, this one's going to blow people's minds. Walmart. Now, this is interesting because you might say, Paul, Walmart is up 5x since then. But here's what you don't realize. Over that time period, over a 25-year period, 5x is only about a 6.5% return. That's not very good. Number 4, I bet you some people don't even know what this company is. General Electric. Guys, this company has been a disaster since 2000. It has gone through tons of issues. They would have been better off in 2000 selling all the parts of the company and giving all the money to investors. That's what's amazing. Number 5, ExxonMobil. This is interesting because it actually went on quite the bull run between 2000 and 2008, rising from 45 to 95. The reason being, look at where oil prices went in 2008, to $140 per barrel. Number 6, Intel. This is one we've discussed a lot in our channel and our community. Similar story to Cisco, but even worse, it has never reached its 1999 highs. In fact, it still trades at a 50% discount to those levels. But guess what? Revenue and profit? Well, revenue is up significantly since then. Number 7, Citigroup. Now, it's a little different because it really saw its downfall during the financial crisis. That being said, if you owned shares in 2000, you would still be down over 75% a mere 25 years later. At the lows, you would have been down over 90%. Number 8, super boring, IBM. This one had a flat decade following the dot-com bubble. Number 9, Home Depot. Great company. Even a name like Home Depot, completely separate from tech, traded at such high valuations in 2000 that a decade later it was down 50%. So I want you guys to remember this. Just because a company is not tech does not mean it can't be egregiously overpriced. And if the market overall falls, as the ETF have to sell assets, these regular names are going to get hit hard. Number 10, Oracle. It took Oracle shareholders 17 years to break even on their investment. I don't think anyone can deny that for the most part, these have been phenomenal businesses, market leaders, dominant players, household names still today. Guys, all these names here are all still around. Yes, this one and this one are very different than they were back then, but these are all around still today. And this story is exactly why tenet number 5 of principle-driven investing is a great story can become a bad investment if you pay the wrong price. And I'll tell you something else. All of these companies here, I'm willing to bet, have higher revenue and profit today than they did 25 years ago. And the stocks have not, for the most part, done well over a 10 or 15-year period after those highs. Now, here's what I'm going to note with you guys. This list from 25 years ago is actually less concentrated in tech-heavy names than today. But what about retail investors? Surprise, surprise, they were far more concentrated in clean-cut.com stocks. Their top holdings in 1999 were Cisco, Lucent, and Lucent, a telecom equipment company that was expected to change the world, but went completely out of business. Microsoft, General Electric, Intel, Oracle, AT&T. Now, similar to Intel, this dot-com darling trades at around 50% of the price it did in 2000. Guys, you ready for this one? AOL. Guys, AOL at its peak had a market cap of $200 billion. They were then acquired after that by Verizon for $4.4 billion, 98% less just 10 years later. Talk about an absolute destruction of wealth. These names were simply overhyped and overpriced, and that's the lesson. When everyone agrees, future returns usually aren't going to be as heroic as you would expect. So now comes the part that really upsets people, but it shouldn't. Smart money isn't necessarily dumb, but it's constrained, and they're humans. And those constraints change behavior in a massive way. Hedge funds don't exist to beat the market over 30 years. They exist to survive year to year and to collect their massive fees. Being early is dangerous when you have clients. Being late is survivable. You can explain that. Howard Marks, who is an excellent investor, who wrote Mastering the Market Cycle and The Most Important Thing, 2 books that I love, always says that being wrong and being early often look exactly the same. If you want the perfect example of why smart money rarely acts early, look no further than Michael Burry. When Burry realized the housing market was built on garbage loans and bad math, he didn't get applause, he didn't get praise, he didn't get magazine covers, he got pure hatred. And guess what? From his own investors. They sued him to get their money back. They accused him of being reckless. But guys, he ended up returning like 450%. Even though he was right, he was early. But he was early for a reason in that regard. But as of late, you've seen him saying, hey, the market's overpriced like 4 or 5 times. The joke amongst people is Michael Burry's predicted 12 of the last 3 recessions. So while everyone else was making money riding the housing bubble, Burry was sitting on losses, watching premiums bleed and explaining over and over again why pain today would mean profit tomorrow. That is not a survivable position for most fund managers. Here's a guy who massively outperformed the market for years. And the second he took a bet that people didn't like, they were suing him. That is not a survivable position for most fund managers. Imagine telling your clients, trust me, you're losing money, but you'll be grateful later. Most investors don't have the patience for that. Most institutions just can't tolerate that. But that's the price of true outperformance. You don't get comfort. You don't get consensus. You get loneliness. Now, fortunately for myself and for members of our community, it's a little less lonely because you have a network of like-minded investors to bounce ideas off of. And for the most part, who are you investing for? Yourself. Guys, I know exactly how it feels to be paralyzed by fear in the stock market. You're probably thinking, I know I should invest, but what if I buy the wrong stock? What if I lose everything? I had those exact same fears 25 years ago. I made massive mistakes. I followed hype, I followed tips, and I lost money. But critically, every mistake taught me a valuable lesson about investing. And that's exactly why I decided to build Everything Money, to take that knowledge and turn it into the tools I needed to make better investing decisions. Now, I want to share that knowledge and those tools with you and build the community that I wish I had back then. So join our community and you'll learn how to see a company's value, how to make smart choices, and most importantly, how to sleep at night knowing that you aren't gambling anymore. You're now an investor. So start your 7-day trial today. Let's take the fear out of investing together. Now, one final note. Burry's back at it again, calling out names like NVIDIA and Palantir, fighting a new battle heading into 2026. So after all this, here's the question that actually matters. If hedge funds are constrained, if being early is punished, then who actually has the advantage? You do, the regular investor, and it's not even close. If you use it correctly. You don't have clients seeking redemptions. You don't have an investment committee breathing down your neck saying we're long-term oriented and then asking you how you did last month. You don't have to explain short-term underperformance to anyone. That means you can do the one thing smart money struggles with most. You can sit on your hands and you can wait patiently. You can do exactly what we practice here at Everything Money. You can learn to buy great businesses when they're out of favor. You can ignore volatility and focus on value. You can think in terms of years and decades instead of months and quarters. Guys, you have no idea how massive a superpower that is. But, and this is critical, that edge only exists if you have a disciplined process. Now guys, I own 28 individual companies. I buy them at the prices that make sense to me. But you know what else I do? I buy low-cost ETFs because at the end of the day, I still want to put my money in the market in a systematic way. And just matching the market will beat 99% of people out there because everybody buys at the wrong time and sells at the wrong time. So if you want to see the companies that fit my process, I picked 7 stocks that I personally believe can beat the Mag 7 over a long period of time. And I'm not going to lie. This year's results were not what I expected. You're going to want to see who made the list, so click on the video on your screen right now, and I will see you there. Thank you for your time.